750 million ounces. That's how much physical silver JP Morgan reportedly holds right now. At $67 per ounce, that's over $50 billion worth of metal. The largest private silver stockpile in history, equivalent to nearly an entire year of global mine production. But that's not the shocking part. The shocking part is where they came from. Between June and October 2025, JP Morgan allegedly closed their entire 200 million ounce paper short position, the short position they'd held for over a decade, the position that silver bulls accused them of using to suppress prices. Gone. Flipped. They went from the market's biggest bear to the market's biggest bull. We've seen this movie before, Act 3 of a 4-act play. 1980, Hunt Brothers, 100 million ounces. Silver went from $6 to $50 in less than a year. And then the crash, Silver Thursday, March 27th. The day silver fell by 50%, from $21 to $10 in one session. But here's what nobody talks about. The Hunt brothers didn't cause the spike. They contributed maybe 75 cents, according to precious metals expert Jeffrey Christian. The real driver was monetary chaos, inflation, dollar collapse, and mass public buying. History doesn't repeat exactly, but it rhymes. And right now, JP Morgan is holding 7.5 times more silver than the Hunts ever did. INA tighter market, with industrial demand that's structural, not speculative, and with debt levels that make 1980 look quaint. Let's start at the beginning. 1973, Nixon's shock aftermath. The dollar is no longer backed by gold. Bretton Woods is dead. For the first time in American history, the currency is pure fiat. No tangible backing, just a promise. And immediately, inflation explodes. Oil embargo, stagflation, double-digit inflation that persists for years. Consumer prices rose by 20% annually at the peak. The purchasing power of the dollar is collapsing in real time. The Hunt brothers saw it coming. Nelson Bunker Hunt and William Herbert Hunt, Texas oil billionaires, sons of H.L. Hunt, legendary oil man. They'd watched Nixon close the gold window in '71. They'd seen what happened when governments broke their promises. Their Libyan oil fields were nationalized by Gaddafi in '73, paper wealth seized by government decree. So they did what wealthy families do when they see monetary collapse approaching. They converted paper into tangible assets. They bought silver, starting in the early '70s at under $2 per ounce. Not as speculation, as insurance, as protection against the possibility that paper dollars would become worthless. By '79, they'd accumulated roughly 100 million ounces. About 1/3 of the privately held global supply was at the time. They weren't hiding it. They told the public. They were systematically building a physical position, taking delivery of actual metal, not paper contracts. And as they bought, the price started rising. $5 in early '79, $11 mid-year, $30 by year's end, and then the acceleration, $40, $45. On January 18th, 1980, silver hit $49.45, an increase of over 700% in 1 year. The conventional story says the Hunts caused it, that they cornered the market, manipulated prices, created an artificial squeeze. But the data tells a different story. According to Jeffrey Christian of CPM Group, one of the most cited precious metals experts, the Hunts might have contributed 50 to 75 cents to the price. Not $50, 75 cents. The rest? Public demand. Ordinary investors worldwide are fleeing paper currencies for physical silver because inflation was destroying purchasing power, because trust in the dollar had collapsed, because when monetary systems come under stress, people return to tangible stores of value. Gold hit $850 on the same day silver peaked. January 21st, 1980. Both metals, same day. Because it wasn't about the Hunts. It was about monetary chaos. But here's where the pattern breaks. Here's Act 2, the response. January 7th, 1980. 2 weeks before the peak. COMEX introduces Silver Rule 7. Heavy restrictions on buying commodities on margin. The leverage that had allowed the Hunts and others to build positions suddenly gets pulled. Then in March, the final blow. COMEX bans all new silver contract purchases, liquidation only. You can sell, you can't buy. Think about that. The exchange changed the rules mid-game. The Hunt brothers had borrowed heavily using margin. They'd accumulated positions expecting to take delivery. And suddenly, the rules said you can't buy anymore. Only sell. The price had one direction left, down. Silver Thursday, March 27th, 1980. Silver drops from $21 to $10, 50%. In one trading session. The Hunt brothers faced margin calls they couldn't meet. $1.7 billion in losses. The banks provided a $1.1 billion bailout to prevent systemic collapse. The Hunts eventually declared bankruptcy, convicted of market manipulation, banned from commodity trading, fined $10 million each. The narrative became legend. The Hunt brothers tried to corner silver. The government stepped in. Justice was served. order restored. But zoom out, look at what really happened. The government broke its gold promise in 71. Inflation exploded. People fled to precious metals. Silver went from $6 to $50 because the monetary trust collapsed. And when that truth became too visible, when silver and gold prices screamed too loudly that the dollar was failing, the government changed the trading rules, broke the squeeze, crushed the price. The Hunt brothers became scapegoats for a monetary crisis they didn't create. That's Act 2, when the system breaks the rules to protect itself. Now, let's talk about today. December 20, 2025, JP Morgan, the name that silver investors have cursed for decades, accused of systematic price suppression through massive short positions, fined $920 million in 2020 for precious metals manipulation during 2008 to 2016, the bank that controlled the paper silver market. And then, allegedly, between June and October 2025, everything changed. Reports surfaced that JP Morgan closed their entire 200 million ounce short position. All of it. For the first time in over a decade, 0 short contracts. And not just closed, flipped. They reportedly now hold 750 million ounces of physical silver, the largest stockpile in history, 7.5 times what the Hunt brothers accumulated, 750 million ounces at $67 per ounce. That's over $50 billion. Nearly an entire year of global mine production sitting in vaults with JP Morgan's name on them. The timing is fascinating. Silver was around $30 when they allegedly started closing shorts in June. By December, $67, up 123% in 6 months. Did JP Morgan know something? Did they see the pattern? Did they realize the paper market was about to break? Because here's what's happening beneath the price. COMEX inventories. The registered category, metal available for immediate delivery against contracts, has been draining. 47.6 million ounces claimed in early December. 4 trading days. That's 60% of registered inventory. Gone. Converted from paper to physical. Total COMEX inventories are down 73% since 2020. JP Morgan's vault, which used to hold 171 million ounces at its peak, has been cut significantly. Other vaults are draining too. The physical metal is leaving the exchange, and it's not coming back. London lease rates spiked to 9%. To borrow silver, you pay 9% annually. Normal is 0.5%. 9% means desperation, means someone needs physical metal urgently, and the supply is tight. The futures market went into backwardation, spot price exceeding futures price. That only happens when immediate delivery is more valuable than promises of future delivery. It signals genuine physical scarcity. And then there's the supply-demand fundamentals. Silver Institute projects a 95 million ounce deficit in 2025, 5th consecutive year. Cumulative shortfall since 2021, 820 million ounces. More silver is consumed than produced. For 5 straight years, that's an Olympic swimming pool worth of silver, drained every year. Industrial demand is accelerating everywhere. Solar panels consume 200 million ounces in 2024. Each panel requires about 20 grams of silver paste. No substitute at scale. Electric vehicles need 90 million ounces annually. Electronics, 5G infrastructure, AI data centers, all require silver, the most conductive metal, essential for modern technology. And mining production? Flat to declining. Grew 1% this year. New projects forecast to add only 44 million ounces over 5 to 10 years. You can't just mine more silver when prices rise. 70% comes as a byproduct of copper, zinc, and gold operations. If those slow silver supply drops, regardless of price, this is the setup. Structural deficit, industrial demand explosion, draining inventories, backwardation, spiking lease rates, and the largest commercial bank in precious metals is allegedly holding 750 million ounces of physical while controlling 40% of COMEX futures. This isn't the Hunt brothers. This is something bigger. Let me show you the pattern. The 4 acts explain what's happening. Act 1, debt accumulation and monetary stress. In the 1970s, it was Vietnam War spending, Great Society programs, and closing the gold window, dollar-backed promises broken, inflation explosion. Today, global debt is $318 trillion, according to the Institute of International Finance. Debt to GDP eyes, 328%. We owe more than 3 times the global annual production. U.S. federal debt alone exceeds $34 trillion. Interest payments consume 15 to 20% of tax revenues. The debt trap, where you borrow not to invest, but to service previous debt. Act 2, flight to tangible assets. In the 70s, people fled dollars into gold and silver, not because of the Hunt brothers, because trust in paper currency collapsed. When inflation runs double digits for years, when purchasing power erodes visibly, people convert paper wealth to physical stores of value. Today, central banks bought 1,037 tons of gold in 2023, highest in 50 years. China is cutting U.S. Treasury holdings to 16-year lows while accumulating gold. Silver rose by 123% in 2025. Investment demand is surging. Same pattern, different timeline. Act 3, the institutional flip. This is where it gets interesting. In 1980, the Hunts were accumulating while commercial banks were short. The banks believed prices would fall. They sold paper promises of silver they didn't have, naked shorts. When prices rose instead, when delivery demand increased, the shorts faced catastrophic losses. COMEX changed the rules, banned new buying, forced liquidation, saved the shorts. But today, the biggest short allegedly flipped. JP Morgan reportedly closed their massive short position and went long physical. They're not fighting the squeeze. They're positioned for it. They control 750 million ounces, 40% of COMEX futures. They've moved from suppressing the market to dominating it. And here's what that means. In 1980, COMEX could change the rules to protect the shorts because the shorts were the system, banks, institutions, the financial establishment. But if JP Morgan is long, is the largest player positioned for higher prices, who's on the other side? Who are the shorts that need protecting? Smaller players, hedge funds, speculators who sold paper silver were betting on lower prices, and COMEX registered inventory keeps draining. 47.6 million ounces in 4 days, 60% of registered. What happens when the next delivery month starts and there's not enough physical to satisfy contracts? In October 2025, India placed an order for 1,000 tons of silver, $22.3 billion, half of the global annual mine production, in one order. And London silver lease rates instantly spiked from 0.25% to 200%. And the entire market froze. Swiss refiner Metalor announced it wouldn't return until January 2026. The system couldn't handle the size. That order revealed how fragile the physical market actually is. How little available supply exists when real demand shows up. And JP Morgan allegedly controls 750 million ounces, 23,000 tons, more than twice India's order, sitting in vaults. This is Act 3, the moment when the largest player switches sides, when the market structure fundamentally changes, when the people who used to suppress prices become the people who benefit from higher prices. Act 4 is coming. The reset. What happens when COMEX runs out of deliverable metal? When will the paper market and physical market definitively decouple? When industrial users can't source silver at any price? When do electronics manufacturers, solar companies, and EV producers all scramble for metal simultaneously? In 1980, silver hit $50, and the government changed the rules to bring it back down. Today, if silver spikes, who changes the rules? Who benefits from suppression? JP Morgan is allegedly long. China restricted exports. Industrial users need physical delivery. The shorts are trapped. History says this. When the largest institutions position for something, when they move from one side of the trade to the other, they know something. They see something coming. So what does $50 billion in physical silver mean? What's JP Morgan's endgame? Theory 1, they're hedging. The modern monetary system is under stress. Dollar reserve status is weakening. China is cutting treasuries. Central banks are accumulating gold. Maybe JP Morgan sees the same pattern. Maybe they're holding silver as insurance, as a hard asset that survives monetary transitions. 750 million ounces as portfolio diversification for a bank with trillions in assets. Theory 2, they're positioning for the industrial boom. AI data centers, solar expansion, EV adoption, 5G infrastructure, all require silver. No substitutes at scale. Maybe JP Morgan forecasts massive industrial demand meeting constrained supply. They control the physical. They can sell into a supply crisis at whatever price the market will bear. 50 billion becomes 100 billion or more. Theory 3, they're preparing for the squeeze, the 1980 squeeze that broke when COMEX changed rules. But this time, they're on the long side. They accumulated 750 million ounces quietly, through COMEX warehouses, through SLV custodianship, through years of steady accumulation, while maintaining short positions publicly to suppress prices. Buy physical low, close shorts, flip long, and now they're positioned for what comes next. A supply crisis that sends silver not to $50, but to 100, to 150, to wherever physical scarcity dictates. Think about the mechanics. COMEX has roughly 350 million ounces of total inventory, registered plus eligible. JP Morgan allegedly holds 750 million ounces outside COMEX. If delivery demand exceeds COMEX supply, if the exchange faces a default scenario, who has the physical to supply the market? JP Morgan. At whatever price they choose. This isn't speculation. This is a market structure. Control the physical in a deficit market, and you control pricing. The Hunt brothers tried this with 100 million ounces. The government stopped them. JP Morgan has 7.5 times that. And they're not outsiders. They're insiders. The commercial bank is at the center of the precious metals market. The question isn't if silver goes higher. The fundamentals say it does. Structural deficit, industrial demand, monetary uncertainty. The question is how much higher and who profits. And right now, all signs point to JP Morgan positioned for the squeeze of the century. Let's connect the dots. Let's see what this really means. 1980, silver $6 to $50, driven by monetary chaos and public buying, broken by rule changes protecting shorts. The Hunt brothers scapegoated, bankrupted. The system survived. 2025. Silver has been worth $30 to $67 so far, driven by structural deficits, industrial demand, and monetary uncertainty. But this time, the largest short allegedly flipped long. The system isn't fighting the squeeze. The system is positioned for it. BNP Paribas says $100 silver is possible. Bank of America's technical team is bullish. UBS forecasts 55 by mid-2026. Those targets look conservative given the current trajectory. Silver went up 123% in 6 months. COMEX inventories are draining. China is restricting exports. India is ordering 1,000 tons. JP Morgan is allegedly holding 750 million ounces. But here's what I want you to understand. This isn't about predicting silver's price. This is about recognizing the pattern, understanding what happens when institutions position themselves for something, when the largest banks move from short to long, when physical markets tighten while paper markets strain, when the structure fundamentally changes. In 1980, silver collapsed because the government protected the shorts, changed the rules, forced liquidation. The system chose order over price discovery. Today, if JP Morgan is long, who does the system protect? Do they crash the price and hand JP Morgan losses, often $50 billion? Or do they let the squeeze run, let silver find its physical market level? Let supply and demand determine price, even if that means $100, $150, higher. The conventional narrative says governments always suppress precious metals, always protect the paper system. And historically, that's true. But historically, the commercial banks were short. They benefited from suppression. If that's reversed, if JP Morgan is positioned for higher prices, does the calculus change? I can't answer that. I'm not inside JP Morgan's strategy meetings. I don't know their actual positions or intentions, but I can read market structure. And the structure says this: the largest accumulation of physical silver in history, held by an institution that previously suppressed the market, in a deficit environment, with industrial demand accelerating, while COMEX inventories drain. That's not random, that's positioning. Whether it's insurance, industrial play, or a squeeze setup, it's calculated, intentional, strategic. And for investors, for people watching this unfold, the pattern suggests awareness, not panic, not get-rich-quick speculation. Awareness that we're in Act 3, that Act 4 is forming. That's when the largest players position for something, it usually happens. Think of silver like insurance, not hoping for a monetary crisis, not wishing for a supply collapse, but understanding risk, understanding that if industrial demand exceeds supply, if COMEX inventories deplete, and if the paper market breaks, physical silver preserves value, stores wealth, provides optionality. The current price, $67, is high by recent standards. But adjusted for inflation, silver would need to hit $125 just to match its 1980 peak. And unlike 1980, when the spike was speculative, today's driver is structural, deficits, industrial demand, supply constraints. That creates secular trends, not bubbles. So where does this leave us? What does JP Morgan's alleged $50 billion position mean? We're in Act 3, the institutional repositioning phase, the moment when smart money moves before the crowd, when the largest players shift from one side to the other, from short to long, from suppression to accumulation. History says this pattern doesn't reverse. When institutions position themselves, they execute. They have information, resources. Time horizons are measured in years, not quarters. If JP Morgan closed 200 million ounces of shorts and accumulated 750 million ounces of physical, they see something coming. Act 4 is the reset. What happens when paper markets can't deliver physical? When COMEX faces default scenarios? When industrial users bid silver to whatever price ensures supply? When the gap between the paper price and the physical price becomes unbridgeable? We're not there yet, but we can see it forming. India's 1,000-ton order is freezing the London market. China is restricting exports. COMEX inventories are draining. Lease rates are spiking. Backwardation. These are symptoms of a market under stress, of a system approaching its limits. And JP Morgan is positioned with 750 million ounces, 7.5 times the Hunt brothers, in a tighter market with structural demand, without the regulatory ability to change rules and crush the price, because this time they're long. I can't tell you what to do with your money. I'm not a financial advisor. I'm a pattern recognizer. But I'll leave you with this. In 1980, the people who held physical silver through the squeeze made fortunes. Then the government changed the rules. The price crashed. Those who understood the pattern, who sold near the top, preserved their gains. Those who held, thinking $50 would become $100, got crushed. Today, we're earlier in the cycle. Silver $67, up 123% in 6 months. JP Morgan allegedly positioned with $50 billion. Industrial demand is structural. Supply deficits persist. The pattern says higher, but the lesson from 1980 says this. When institutions position themselves, they also know when to exit, and retail investors are usually the last to know. So ask yourself, are you aware of the pattern? Can you see Act 3 unfolding? Do you understand that Act 4 brings both opportunity and risk? That being right about direction doesn't guarantee profit if you don't understand timing. Drop a comment. Tell me what you think JP Morgan sees. Tell me if this is the setup for the biggest silver squeeze in history, or if I am connecting dots that aren't there. And if you want to understand what happened after Silver Thursday in 1980, how the market recovered, what signs appeared before the collapse, hit subscribe. Because next week I'm breaking down the full 1980s precious metal cycle. The boom, the crash, the 20-year bear market, and what it teaches us about knowing when Act 4 peaks and when it's time to take profits. JP Morgan holds $50 billion in silver, the largest stockpile in history, 7.5 times the Hunt brothers, in a market that's tighter than 1980. With demand that's structural, not speculative, the pattern doesn't care if you believe it, it just executes. And right now, the largest bank in precious metals is positioned for something. And the question is what? And whether you're ready